Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Briggs. Let's get you up to speed on this afternoon's market action. We have stocks hovering near the flat line after a mixed bag of earnings from some key Dow components. You're looking at the Dow just below the flat line, off just about 5 points.
But investors shifting their focus to Netflix as we speak. Stock up just a bit. They report after the closing bell. We'll have the numbers and analysis as soon as the report hits the tape.
Plus, the debt ceiling debate in Washington. House Speaker Kevin McCarthy facing a challenge from within his own party on making a deal. So how big of a task will it be to get something done? And we will get the odds on that later on in the program.
We start with another big day for the big banks. Let's start with Bank of America, who beat expectations on the top and the bottom lines while posting a rise in profits boosted largely by higher interest payments. However, deposits at the bank were down 2% after March's banking crisis spooked customers a bit. And on the earnings call, Bank of America CEO Brian Moynihan wasted no time defending the slowdown. Listen.
As you think through all the tightening actions of the Fed, the flows to alternative yielding assets, investments, and the disruption of the past quarter, our deposits continue to perform well, ending the quarter at $1.91 trillion. If you think about it, that's about the same balances we had in mid-October of 2022. So we've seen these balances stabilize.
Also reporting this morning, Goldman Sachs beating on earnings but missing on revenue, falling 5% year over year as it takes a hit from the sale of consumer loans and weaker than expected bond trading results. Goldman's fixed income trading revenue fell 17% on lower activity in currencies and commodities, while Bank of America's grew 30% year over year, driven by improved performance in mortgage, credit, and municipal products. Shauna.
Yeah, certainly, Dave. When you take a look at these reports, I mean, let's start with Goldman because, yes, it was clearly a very disappointing quarter here for the company. Their profit was off about 18% from a year ago, but the tone on the earnings call was pretty optimistic given the stress that we had seen in the banking sector during the first quarter and given the fact that there's been so much talk of a recession. Specifically, what I'm talking about is when CEO David Solomon said on this earnings call that, quote, the worst of the crisis is over. He also expressed some confidence here on the second half, some big strategic, that was a quote there, deal activity in the second half of the year. When you take a look at the investment banking fees from this latest quarter, they were down 26% on a year over year basis. Some of that weakness there they blamed, and partly because of the drop that we have seen in deal making activity. Clearly, that's so crucial for a bank like Goldman. So that relatively optimistic tone that was heard on the earnings call, I think, is a little bit reassuring here for the sector.
A little bit in contrast to Brian Moynihan, who said our research team continues to predict the shallow recession will occur beginning of the third quarter of 2023. He did say the U.S. consumer is in great shape, but then contrasting that when you take all these banks into consideration, the four biggest banks combined wrote down $3.4 billion in future loan losses. So that tells you they all believe at some point, second half of this year, there is, if you want to use Jamie Dimon-like imagery, storm clouds on the horizon in some form or another.
Just hopefully it's not too big or too worrisome of a storm out there. All right, let's also get you up to speed on the latest here from Washington, from Capitol Hill. SEC Commission Chair Gary Gensler testifying on crypto regulations before the House Financial Services Committee. Yahoo Finance reporter Jen Schomburg following that for us. Jen?
Good afternoon, Shauna. In a contentious ongoing hearing right now, Republicans on the House Financial Services Committee are taking SEC Chair Gary Gensler to task on what they view as an overly ambitious agenda. In a hearing that's going on more than 4 hours now, with focuses largely on crypto regulation and climate disclosure rules, Committee Chair Patrick McHenry told Gensler this morning to, quote, get comfortable. We're going to cover a lot of ground today. And indeed, they have so far. McHenry leading the Republican pack, laying into the SEC's approach on regulating crypto and trying to understand whether Gensler views Ethereum, the second largest cryptocurrency, as a commodity or a security after Gensler has said that Bitcoin is a commodity. Take a listen.
So I'm asking you to speak to a second one, the second largest market cap here.
And speaking to the tokens, there's 10 to 12,000. if there's a group of entrepreneurs in
I'm
the
asking
middle
about
and
one.
the public is anticipating a profit based on the...
I'm asking a specific question, Chair Gensler. I said this in private. This should be no shock to you. I'm asking this question. Is Ether a commodity or a security?
And again, it depends on the facts and the law, and if there's a group of individuals...
I'm asking about the
in
facts and the
middle-
law sitting in your seat and the judgment you are making.
McHenry accused Gensler of refusing to provide clarity to crypto firms on what constitutes a security contract, saying he's punishing companies for not complying with the law but aren't providing clear rules of the road. Appearing for the first time before this GOP-led panel, the SEC chair pushed back and defended the agency's approach.
It's not a matter of lack of clarity. I think this is a field that, in the main, has built up around non-compliance, and that's their business model. And they have chosen, even though it's not the law, they've chosen to be non-compliant and not provide investors with confidence, protections, and it undermines the $100 trillion capital markets.
Gensler has said nothing about the crypto markets is incompatible with current securities laws and reiterated that the vast majority of crypto are securities. He says it's, quote, the law. It's not a choice. Calling yourself a DeFi platform is not an excuse to defy securities laws. Now, when pressed on climate change rules, Gensler said the SEC is trying to help investors better understand climate risk to a company when they buy or sell securities, and that the agency really just wants to bring consistency to that. Guys?
Yes, that would be nice. Meanwhile, on the Senate side, Elizabeth Warren and Jack Reed sent a letter to the Treasury asking about Silicon Valley's bank failure. What was in that letter?
Hey there, Dave. Yeah, in a letter that I obtained exclusively, Senators Elizabeth Warren and Jack Reed wrote a letter to the Treasury Department's Office of Financial Research, asking about concerns about the department's failure to use its authorities and tools to prevent the failure of Silicon Valley Bank and Signature Bank. Those senators writing in a letter, quote, recent turmoil in the banking system following the failures of Silicon Valley Bank and Signature Bank, which forced financial regulators to take extraordinary action to stem contagion, underscores the need for OFR to use all its tools to live up to its mission and help keep our financial system safe. The senators are urging OFR, which supports the Financial Stability Oversight Council, to really fill those data gaps. This letter coming on a day when President Biden's nominee to serve as the new director for OFR, Ron Borzakowski, testified before the Senate Banking Committee this morning in his nomination hearing. Dave?
Extraordinarily busy day on Capitol Hill. Jen Schomburger, thanks so much. Appreciate that. Let's get you up to speed now on the start of tech earnings. First up is Netflix, reporting after the bell today, and shares moving just a bit today, up about 0.75%. Ali Canal here with what we can expect to see. Ali, what's the expectation, and how much are we going to see in the report versus what we're anticipating to hear in the call?
Well, that's the big thing. I think for this earnings report, it's not necessarily going to be about the numbers. It's going to be about the commentary that we receive in that earnings report, in that earnings release. JP Morgan, they published a new note earlier this morning, basically emphasizing that it's not about the first quarter. It's really about what we hear when it comes to the password sharing crackdown, when it comes to ad supported for those users. Now, these are both two huge revenue drivers that Netflix is really looking forward to really seeing the fruits of that play out towards the back half of this year and into 2024. Now, before we get there, there's going to be a lot of short-term noise, especially surrounding churn. JP Morgan published a new note this morning demonstrating how some of that noise has already played out, with Google search trends for the phrase cancel Netflix peaking around the time the company announced its crackdown on password sharing. So you're seeing right there on your screen around January and February of this year. Now, because we haven't seen this crackdown roll out in the US just yet, as well as some other major countries like Brazil, I have noticed a lot of analysts upwardly revising their subscriber guidance for Q1 and lowering their sub forecast for Q2 in order to reflect any potential churn that we could see down the line as this rollout continues. But I will say that consensus estimates overall for the quarter, they have subscriber net additions coming in at 2.3 million, with revenue estimated at $8.18 billion, earnings expected to come in at $2.86 a share. But like I said earlier, for this particular report, it's not necessarily going to be about those quarterly numbers. It's going to be about the commentary, the color in the release, in the earnings call, because investors, they have a lot of questions that they need answers to, right? When will this password sharing crackdown hit the US? What will that look like? How has the ad tier been performing? What the heck happened to the Love is Blind live reunion special? So, you know, I could go on and on here, even when it comes to theatrical, right? With how well Amazon did with Air, releasing that in theaters. Will Netflix change its stance on that? So there's a lot really to be discussed here.
And we don't know how a call goes in the post-Reed Hastings
Exactly,
era, right?
the first earnings report since Mr. Reed left the company.
But a massive glitch there for their live programming. So any commentary on that, I think, is going to be huge.
I would be shocked if they didn't address
Shauna
it.
was waiting up all night for that Love is Blind
She
reunion.
wasn't alone.
And she never got it.
A lot of people were, and people were very, very upset about it. So, you know,
It was trending all over the place.
All right, Allie, great stuff. Thanks so much. And of course, we'll have you covered on after the call, where we've got you all the biggest headlines here from the earnings call that will get underway this afternoon following the bell. All right, let's dive more into these bank earnings, because again, a mixed picture here from Wall Street. Bank of America actually beating expectations. Goldman Sachs, you can see that stock off just about 2% with less than an hour to go in the trading day. Joining us now, Zach Hill, Horizon Investments Head of Portfolio Strategy. Zach, it's good to see you here. So just first, I guess, your read on the bank earnings so far. Is it fair to say that the worst is behind us?
Yeah, so great to be with you here, Shauna. So, you know, high level as we're looking at things, you know, from a more macro perspective, as opposed to kind of in the weeds, you know, the bank earnings we've seen so far have been better than feared, I think would be the way that I would categorize it. You know, we're looking at guidance, how they're thinking about loan growth and deposits. And quite frankly, you know, the biggest banks in the U.S. have benefited from the situation that's been happening for the last month. And so, you know, we're seeing that reflected in a lot of their stock prices. Now, the real question for me is, does this continue to the small and mid-sized banks? And we're going to get some of those reports later this week and next week. And, you know, certainly I think that might be a little bit of a different story than what we're seeing in the large caps today and so far this earnings season.
I want to get to that in a sec. But speaking of what we're seeing in shares, Bank of America, pretty solid report all the way around, and yet shares basically around the flat line, up a 1/3% as we speak. Are you surprised at the investor reaction?
Well, you know, the large cap financials have really been rallying, you know, since the kind of the back half of March, as people realized this was not a 2008 style situation. And certainly last Friday, where we kicked off earnings season, was a good day, you know, for the overall sector. And so I'm not surprised that we're not, you know, propelling higher from here. Really, the kind of thing that's interesting to me is a divergence between a lot of the large cap banks and, you know, the smaller cap banks, which are not faring very well today. And so that's something I think from a more macro perspective that we're keeping a big eye on.
But wouldn't you expect a better investor reaction to a pretty stellar report from Bank of America?
Yeah, I mean, you know, I think in a market like this where there's just so many cross currents, a lot of things to think about, you know, drilling in on a few hours worth of price action, especially when the narratives are changing as quickly as they are, is just a way to kind of get chopped up. And so we're at a high level, we're trying not to do that. You know, as people that are actually, you know, running money and live strategies, you know, in this market environment, we're trying to pull ourselves away from that. And what we see, you know, overall is, you know, better than feared, for at least from the large cap banks, in terms of what the economy is going to look like. And when you couple that with a lot of the momentum that we had going into this from the consumer side of things, that is a little more optimistic on growth in the U.S. this year.
Well, Zach, what do you think the economy is going to look like? Because there's a Bank of America fund manager survey that was out. 63% expect a weaker economy in the next 12 months. I don't think that number is particularly surprising. But when we talk about how weak, do you think a recession is in the cards and likely?
Yeah, I mean, that's not really a heroic call, right? I mean, we're running at really elevated levels of nominal GDP. And so, over these last 2 years with inflation obviously much higher than what we've experienced in a long time, there's this kind of the dichotomy between nominal versus real growth. And I think that's kind of messed people up a little bit because we're not used to thinking that way. And so, at a high level, we do think things are slowing and they're going to continue to slow. I mean, that's exactly what the Fed is telling you they want to do. I think they're going to accomplish that, one way or the other. But then the question is, does that kind of spiral into some uncontrollable situation? And there, I think the starting place really matters. Really good debt service and leverage on both the corporate and the consumer side of things. There's some pockets of weakness. We may see some ups and downs. We're familiar with those. Over the last 3 years, if you were a goods producer in 2020 and 2021, you had boom times. And now if you're in the services, you travel, leisure, that type of thing, you're feeling boom times, whereas it was a complete recession for you 2 years ago. And so I think that kind of up and down stuff is going to continue for a while. But our broad read is that things are going to continue to kind of chug along here. I mean, we are late cycle. I think that's clear, but not the end of the world coming around the pike, at least as far as we see it.
You referenced the Fed moves. What do the better than expected bank results, how do they impact the future Fed moves?
Yeah, Dave, this is a really interesting question and one I think the market is grappling with. So, we saw a gigantic re-rating in Fed expectations post SVB, from 4 hikes to 4 cuts. I mean, that is really historic moves in the bond market. And the market clearly voted that this means the tightening cycle is over. And, this means that they're going to have to start cutting because they've broken something. And, we take the other side of that. There's some isolated cases within a few very poorly managed banks with, really quite incredible business models if you think about it. And it's not a systemic thing. And so, we've got a situation where you're substituting a little bit of credit overhang for additional rate hikes. And what exactly that's worth is something that the market is grappling with. And so we're not really surprised to see interest rates start to march higher. And furthermore, we're not really surprised to see stocks actually do okay in that environment because they're marching higher for the right reasons, right? They're marching higher because there's not a crisis in the banking system. And so we think that's good up until a point. And, where that point is exactly, I think it's a little bit higher than where we are today. But that's something that we're certainly keeping an eye out for.
What does this mean then for investors? Should they be still on the defensive side of it, or is it time to start maybe adding some risk given the fact that maybe we could see an upside here over the next several months?
Yeah, well, for long-term investors, I mean, I think the place to be is still the stock market. It's pretty clear that you need to be in that engine of growth. Rates are higher than they have been, but they're nowhere near where they were over a 30 or 40-year average type of period. And so that's kind of the high-level thing. And then where we think about positioning more tactically, and we are an active manager, we're thinking about the kind of the way things are going to unfold in terms of scenarios. And our kind of central scenario is a muddle-through situation. And so then where do we want to be positioned? Well, it's really kind of tilted towards quality. A lot of that is the kind of the tech and the larger cap trades, and looking for opportunities, where the markets get a little overextended, a little ahead of themselves. And certainly it looks like we may be doing that as we sit here today, to be a little bit more defensive, but not to do that full on recession trade type of positioning. And the areas that we're staying away from, the highly cyclical areas, things like small caps, energy, it's not 2022 anymore. We don't have this supply overhang situation. And so, we're staying away from that cyclicality within the U.S. And looking instead for opportunities overseas, because we do see quite a lot of value in international stocks, and especially in Asia and with the China reopening this year.
All right, Horizon Investments, Zach Hill, good to see you, sir. Thanks so much. We're just getting started here on Yahoo Finance Live. Coming up, NVIDIA's double upgrade, HSBC turning bullish on the chip maker.
And raising its price target to $355 from $175. I'll tell you why the analyst behind that call sees a positive outcome for the stock. And Q1 earnings season is underway. Netflix and United Airlines are reporting after the bell today. We'll bring you those results as soon as we have them. Don't go anywhere.
Yahoo Finance goes live after the call. This time, we're zeroing in on Netflix. Ticker symbol NFLX. You know them, you love them, you watch them. Whether it's Love is Blind, whether it's Beef. Netflix has been the tried and true and battle-tested streaming content provider. What does that outlook for growth look like from this point forward, as they've already spent billions of dollars to get into your home and onto your screens as well? And so we're going to hear about what the subscriber counts are right now. We're going to hear about how their international presence has continued to expand. We're also going to hear a little bit more about their own inclination to continue to add on to the different types of features that they've already put into the platform that could perhaps widen out that customer base at the end of the day. So before you tell me exactly what your favorite Netflix title is, I'm just going to let you know that we're going to be tracking all things Netflix. After the call ends, that's when Yahoo Finance begins. We go live and we break down the tick by tick for you on the Wi-Fi Interactive with after-hours trading moves as well. Tune in after the call. NFLX Netflix, you know what it is.
While artificial intelligence systems are sweeping corporate America, Elon Musk has a plan of his own, and it's called Truth GPT. He was involved in the initial funding of ChatGPT, but the Tesla CEO said in an interview that he fears existing AI businesses are training their systems to be, quote, politically correct, and that he thinks this new platform might be the best path to safety. For more on this, we want to welcome in Callie Hayes, Insider Tech correspondent. Callie, a lot laid out there in this interview here from Elon Musk, obviously comparing what he wants to build to what's already out there with ChatGPT. What did you make of the headlines and how realistic maybe some of his ambitions are within this space?
Well, top line, I think I'm always interested in how little he explains what he's saying. There's usually not much added beyond the quotes that kind of get thrown around in terms of truth and existence and humanity. So I think that's always worth noting. But going forward, I mean, it's more actions than words. It'll be interesting to see what, if anything, comes of this project.
Yeah, and Callie, I know one of the things that you were closely tracking is the investment here from Musk into new generative AI project at Twitter. What can you tell us about that specific project? And I guess if you have any sense of the timeline of that.
It's a great question. The timeline would be very good to nail down, but overall it's a LLM, or a large language model. So that is purportedly being trained on Twitter data. The people that he's hired, the engineers that he's hired, several from Google's DeepMind project, they are technically employees of Twitter, which is now part of X Holdings. So they are ostensibly taking Twitter data to train this large language model, which is sort of the baseline for these AI projects to go out and then create new content on their own. They need huge amounts of data input to do the things we see a chat GPT do, for instance, which is sort of talk like you would think a person would talk, or respond in an authoritative way on a subject that you prompt it to discuss.
So fair to say it sounds like in the very early stages of this?
Very. And the amount of GPUs that he's purchased too is also a signal of a very early stage LLM AI training project. 10,000 GPUs is a lot. It's a lot of money. It's probably around $100 million that he spent on that number of GPUs because they're very expensive, but it isn't the amount that you need to even operate at the level of a chat GPT is operating at as yet.
Kelly, given all this, what do you make of the fact that Elon Musk was one of the signatories of that Future of Life Institute warning that we need to pause AI all while he tries to develop it?
Musk is definitely a man of contradictions, to put it politely. He tends to say things and do something else. I think people who have followed him for the last several years would not argue with that. So it's ironic that he would do something like that, but I think not totally unexpected given his past actions and comments.
Kelly, you cover this space very closely. I mean, there's so many players now within AI. Every single tech company, it seems like, wants to mention AI with its investors, with the analysts in its earnings releases. When you stack up who is in the lead, I think a lot of people clearly agree that it's Microsoft. But how many players should we be thinking about, should we be worrying about here when we talk about some of the risks that are associated with AI?
So many. There's so many people who are getting involved in this. There's so many startups being founded right now as we speak. Hackathons are happening in San Francisco every day almost, trying to figure out new use cases for AI, and these startups using ChatGPT and trying to figure out new ways that it could be applied to basically any industry you can think of. So I guess that's part of the worry. But all in all, I think generative AI as a whole is more about improving current processes more than, taking over humanity, as some very outspoken people seem to think. It's going to really improve search. It's possible that it could really improve the medical industry. It's about thinking before you use something like this, don't dump all of your financial information into it and expect it to be fine. But there is truly countless startups right now as we speak being founded, trying to use generative AI in a new way.
And there's the original startup. And because inconsistency might be the most consistent thing Elon does, he helped found OpenAI. Why did he walk away?
There was some reporting about this on The Time, and it's before my time covering him. But there was a possible power struggle. There were possible disagreements between Sam Altman, who's sort of the head face of OpenAI at this point, and Musk specifically, even though they kind of previously had a mentor-mentee relationship. So there's a lot of palace intrigue there, but it seems pretty practical to say at this point that Musk maybe sort of regrets getting out of that company. It would have been probably a huge boon to his reputation had he stayed and been at the forefront of something like generative AI.
Callie, give us a sense of what's going on inside the walls, behind the doors of Twitter right now, because when we talk about this ambitious project, maybe from Elon Musk, you're saying it's going to cost a lot. And Musk has said numerous times that Twitter is on unstable footing when it comes to its financials. How dire of a situation is Twitter in right now?
It's more dire for the people that work there, maybe, than the company as a whole. It's a very, very tough place to work. Many people who are there genuinely feel stuck working there for one reason or another, be it the finances or their HB1 immigration visas, stuff like that. So, but in terms of the company, I mean, it's still functioning. I think people predicted that Twitter could function with many, many fewer employees than it had. It's down. Well, Musk says that it has about 1,500 employees, which is a shocking reduction. I've heard that it's actually a little bit closer to 1,000 people, which is an even more shocking reduction. But it also goes to show why the site has been increasingly glitchy. But then again, the level of glitchiness that users who have really come to love and put a lot of time into a platform are willing to put up with. So tech leaders throughout the industry are really watching everything Musk does at Twitter extremely closely, and many of them are kind of following suit in their own way.
They certainly are, and so are we, watching every single development out of that company. Callie Hayes of Insider, thanks so much. Well, coming up, shares of Roblox looking to regain some of its earlier losses from yesterday. Today, we're looking at gains of just about 1.6%. Now, the sell-off yesterday came after the company released its key metrics for March, showing a potential drop in average bookings per daily active user. So is now the time to buy? We'll get analyst reaction on the other side of the break. Roblox disappointing the street this week after disclosing some key metrics that fell short of expectations. The company warned that it now expects average bookings per daily user to fall from a year ago. Our next guest, though, saying that now is still the time to buy. Joining us now is Franco Granda, D.A. Davidson analyst. It's great to see you here, Franco. So you reiterate your buy rating on the stock, $55 price target. Clearly, you must think that yesterday's sell-off was an overreaction. Why are you so optimistic?
Yeah, first off, thanks for having me. And then you have to think about how or what drives Roblox's business, right? It has to do with the DAUs, the number of users, the number of hours engaged per user, and then the monetization, right? So the monetization piece right now is suffering a little bit due to the pandemic, right? That's due to people not spending money due to inflation and whatnot. And then you also think about the seasonality of the business. When kids are in school, they're less likely to spend money. But when the summer picks up, that's when the monetization really kicks in for the company. So what my argument here is that you have to focus on the user growth and the hours of engagement for the company, because once the monetization piece comes back, that's when you'll really see the top line accelerate.
Yeah, the surprising number was the daily active user, to your point, up 26% to 66.2 million. Were you surprised to see the stock a significant drop despite that number?
Absolutely. I think that people, got a little bit ahead of themselves in terms of expectations. I think many were looking at the mobile gaming data and what that suggested for what the first quarter number would be. And people were thinking that it would be a nice beat. But it seems like the mobile gaming business is staying strong, but it's the other side, the consoles, the PCs, that are not holding on as strongly. To that end, I think that the user number, that to me was impressive. And the drop is unsurprising because that is just seasonality. You have January being strong after 4Q, the holidays, dip in February. And then the fact that it dipped again in March is not surprising. We should see that kind of ramping, like I said, as the school ends and people have more time.
Franco, what about the fact that the company is no longer going to provide those key monthly metrics? How does that change how you evaluate the company, how you look at this company from an analyst perspective?
Yeah, absolutely. Clearly, whenever we have less data, it's not good for us. But I'd say it's unsurprising that they're getting rid of it. If you look at the stock reaction, whenever the company published the monthly metrics, the stock would be up or down over 10 double digits every day that they posted those metrics. And so the fact that they want to get away from that noise intra-quarter before they're able to talk about the quarterly dynamics and what's going on in the fundamentals of the business, and that is really the reason why they're getting rid of it. I wouldn't read past that, as that's how I see it. But in the meantime, trends we'll be watching out for will be credit card data, the number of posts online, or that mobile gaming data, which seems to be having a strong correlation to the top line of the entire company.
And their price target has about 37% upside, so it'll be an interesting story to watch. Franco Granda, nice to see you. Thanks so much for that. Coming up, Teladoc shares are popping today after the company says it's expanding its services. Stay tuned to find out how. Next.
It's time for a triple play. Three stocks that we're watching in the final 30 minutes of trading: Teladoc, Southwest Airlines, and Lockheed Martin. Let's kick it off with Teladoc. The stock getting a boost today, up just about 5%. Now, we were looking at the biggest intraday jump in just about 2 months earlier. Now, the move higher coming after the company announced that will now cover weight management, which includes prescribing weight loss drugs, as well as pre-diabetes programs. Now, this move also comes amid a surge that we have talked about many times here at Yahoo Finance in the popularity of weight loss drugs. Analysts expect that the global obesity market to be able to generate around $50 billion in sales by 2030, really speaking to the growth opportunity here within this space. Now, remember, Weight Watchers also made a big move into this industry as well with its acquisition of Sequence, which is a weight loss drug prescriber here. And you can see by the stock's reaction in the market today, Brooke, that this is clearly something that the street sees the runway growth potential of, and what's getting more investors on board with a name like Teladoc.
Yeah, and what's interesting too is Teladoc really took a pulse, really made a name for itself. It went public back in 2015, but during 2020, it definitely got a boost because of the fact that everyone's doing virtual visits. And now with all these acquisitions, really looking to continue its pulse on consumers and remain top of mind. I know that this is something that you've been watching as well, Dave.
Well, in particular, these diabetes drugs, which I believe is the future of pharma. You mentioned a $50 billion estimate. There are some that are double that.
Right.
Some believe it is a $100 billion a year industry because the one that's coming, and that's Mounjaro from Eli Lilly. Right now, it's all about Ozempic, most typically, but they think Mounjaro will change this industry. People are losing up to 50 pounds on average. Insurance companies are already buckling and conferencing on how they're going to decide who gets covered for this and who is just taking it to shed a few pounds. This will change everything as we know it. It's changing the diet industry, it's going to change pharma, and it's going to change insurance companies. You're talking about a mass. I think it's the AI of pharmaceuticals, if you will. How's that?
You heard it here first.
That's almost like a Dan Ives statement.
Yeah,
it is
been spending too much time with
the
it.
artificial intelligence of pharmaceuticals.
Okay. Yep. All right.
Well, from one consumer company looking to bounce back
argue with that one.
from the pandemic to another company that's looking to keep up the momentum it's made since the pandemic is Southwest Airlines. Shares this morning fell, though, more than 3% after the airline briefly grounded all flights due to technical issues. The company said the interruption was caused by data connection issues resulting from a firewall failure. Now, it said that the firewall was from an outside vendor. Now, this comes nearly 5 months after all airlines were hit by a severe storm back in December, and Southwest's crew scheduling system wasn't able to keep up, causing the airline to cancel 17,000 flights and costing the company nearly $800 million in lost revenue. Now, the company is expected to post earnings results next Thursday, I believe, the 27th. Analysts expect adjusted earnings per share to come in down 22 cents and revenue to come in $5.73 billion. And so certainly a company, as many airlines, analysts here are expecting a mixed bag for airlines, certainly sort of an airline industry, interesting array of different companies that I think they'll report differently based upon consumer demand, based upon how they're handling labor. And so certainly interesting to see what comes out next week.
Yeah, they're all dealing with new pilot deals and huge demand. But Bob Jordan, above all these CEOs, has his hands full because he's going to spend $1 billion upgrading the technical systems. I don't know if they're going to change this point-to-point system to a hub system like the other airlines. It may not be Bob Jordan's problem that they're in this mess, but he's the guy that's going to have to turn it around, and it's going to be a heavy, heavy lift.
It's going to be a very heavy lift. And you're also looking at a group of customers, those that are still loyal, that are still flying Southwest, that are going to be able to continue to possibly stomach delays like this. 40% of the flights were delayed yesterday. And if you have had anything to do with the cancellations or the delays that this airline has experienced, they're up against a tough competition out there. In some respects, I guess every airline deals with some sort of cancellations, as I experienced yesterday. But I do think people that have been loyal to Southwest have a very low tolerance for issues like this.
Yeah, two of the people here were on the wrong end of some United snafus.
And they're going to be
different story, Dave. Different story, Sean.
They're dealing with their own issues, which we will talk about United later. LMT is my play. Lockheed Martin, the stock surging to a record high today on the heels of Q1 results that topped analyst expectations. Revenue up less than 1%. To more than $15 billion, though. However, the company does expect revenue to decline this year due mainly to supply chain constraints. Their aeronautics revenue declined 2% due to a backlog primarily of F-35 fighter jets. Lockheed did see a boost in contracts related to the war in Ukraine, but some will take several years to play out. Their CFO elaborated on that in the call, saying the company will see $1.5 billion in sales related to the war in Ukraine this year, about the same as last, but up to $6 billion by 2027. In other news related to Lockheed, China has banned senior executives from both Lockheed and Raytheon from entering, working, staying, and residing in the country, also banning them from imports and exports related to China. As you might imagine, the foreign minister says the move is resulting from two companies selling arms to Taiwan. The stock, you can see, has a very solid day, up about 2.5%, $501 per share. But that China issue, Shauna, is going to be rearing its head over the next couple of years. In fact, that might be the most important issue in the next presidential election, because there is bipartisan agreement that we have to decouple ourselves in some regard. How do we do it? And I hate to say it, I don't hate to say it. I will say Donald Trump may have been right here, right? Wanted to ban TikTok, wanted to be tough on China. The tariffs certainly didn't play out how we might thought, but this is going to be a major issue in the next 10 years.
Yeah, certainly. And you're right. This is one area where both sides of the aisle tend to agree that we do need to pare our dependence on China. How exactly that happens, I think that is up for debate. And I think that is what a lot of people are questioning right now. And it is across every single industry. We know how critical China, the development there is for the chip industry. Washington has put forward the CHIPS Act last year, hoping to boost production, really boosting production, clearly, of chips within the United States. Technology, obviously, you had Tim Cook over speaking with China leaders over the last several weeks. We know Apple's dependence here on China, specifically for the production of their iPhone, for the production of some of their other very important products. So it touches just a number of industries here, and it's going to be an issue that clearly will come up several times, obviously inside the Beltway, but as we lead up to the 2024 election.
Yeah, and just to hit on that, shares up today nearly 2.5% on Lockheed Martin. Year to date, up more than 3%. And so certainly gaining the attention from Wall Street here.
All right, we'll leave it there on that. But coming up, NVIDIA getting a boost on Wall Street today after losing its only remaining sell rating. Next guest is going to tell us what's in store for chip makers this earnings season. That's next. NVIDIA getting a boost here from the street today after losing its only remaining sell rating. HSBC giving the chip maker a double upgrade to buy, raising its price target from 175 to 355 on NVIDIA's AI potential. The chipmaker climbing by just over 2% today. Year to date, though, you're looking at gains of nearly 90%. Joining us now is Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. It's great to see you here. So clearly, NVIDIA, lots of upside potential, at least HSBC thinks, in terms of the AI and investment there. What's your current view on NVIDIA and the run-up that we've already seen year to date?
So the way I look at this call today, you hit the nail on the head. This is the last analyst capitulating who had to sell. And what happens with reported sell-side research is when the stock runs, they have to change their calls or else they look awfully bad. So I don't know if anything was incrementally revealed today. I think NVIDIA will be one of the leaders in a basket of AI stocks, though right now I think the stock is a little expensive and maybe even more than a little expensive, could be even a lot expensive. I own the stock, but it's not one of my big holdings, not because I have a fundamental issue with it. I think it's going to be just fine. I just think after up 90% nearly year to date, it may be ahead of itself. Let's hear what they say on their next conference call about their outlook. I hope it doesn't disappoint.
Yeah, really hard to imagine more room to run after the year they've had. How has artificial intelligence essentially remade the entire sector from an investor perspective?
Well, particularly with the semiconductor names, we're all coalescing around who are going to drive these chips. Now, the nice thing about these AI chips is that they will come with much higher price points and much higher profitability. So maybe some of the move in NVIDIA is justified. There will be some other players too. I think Advanced Micro Devices, AMD, will be a player in the space. The problem with that particular company is, at least in the near term, it's diluted by pretty poor fundamentals in the global PC business. But there will be more, but NVIDIA will probably be the leader specifically in the AI segment.
Paul, how much of, I guess, is the worst of the route that we certainly did see in the chip makers last year? NVIDIA was one of those names under a tremendous amount of pressure up until around the fall, October. Is the worst of that behind us? And what does the runway of growth look like for a number of these names?
I think the semiconductor companies should have a better second half. The only question is, how much is that already baked into their stock prices? A lot of PC companies have done poorly. The smartphone industry has been in decline. And even though the bulk of the semiconductor industry has moved away from those two end markets over time, they still have at least some of dependence. And so the coast will not be clear until we get a resurgence in both smartphone unit demand and PC unit demand. AI is great. It'll be a big deal over time. But right now, there are some other areas that we have to worry about. That's why I think some of these stocks, particularly the ones that have just cascaded upwards since last fall when they troughed in October, may, if they don't deliver outstanding fundamentals like huge meet and beat numbers the next couple of quarters, people will say, wow, that stock's kind of expensive. I can't buy it here. Maybe I should even sell it.
Paul, how are some of these chip names and perhaps other names in the tech space benefiting from a perception that the Fed will pause, if not cut rates later this year?
That's my greatest concern. I think right now it's the 80-20 rule, not just in semiconductors, but in technology. In the first quarter of 2023, the Nasdaq is up 17%, which is a great year in a single quarter. And the more value-centric Dow is flat. And I don't think it is because tech companies have necessarily distinguished themselves. The biggest story so far in tech this year has been how many people you can fire and cost cutting. What has driven these stocks, and almost solely has driven these stocks, is the perception that not only the Fed stops raising rates, which I think is accurate, but turns around and pivots and starts lowering them. I don't think that part's going to happen. And if that doesn't happen until deep into next year, which is my forecast, you might have some comeuppance in these stocks, particularly the tech names and other aggressive growth names that are totally being propelled by the view that the discount rate will go lower, which is the Fed will start to pivot and lower rates. Don't think it's going to happen.
A reckoning could be on the horizon. Paul Meeks, enjoyed the conversation. Thank you, sir. All right, a big announcement from Ford coming in last night. The company will be importing its next generation Lincoln Nautilus from China to the United States. Yahoo Finance senior autos reporter Praz Romanian here with the details. Hello, my friend. What are we learning?
Hey, so just last night they had the reveal of this car in New York City and simultaneously in China at the Shanghai Auto Show. Interesting enough. So we saw this in the flesh. It's actually a very good looking SUV, very sleek, sporty, new inside and out. I would say it almost has like a Range Rover Sport-esque kind of look to it. Inside, I was kind of shocked to see this fully wrap-around digital display across the entire dash, including in the passengers area. I was very impressed by that. Kind of gives you an idea where the brand is going in the future. But you mentioned that car built in China, but also a new powertrain there, a hybrid powertrain. I spoke to Lincoln President Diane Craig about why that's so important for their customers.
Certainly in the medium premium utility where Nautilus competes, being able to offer gas and a hybrid alternative for our customers, is really important to our customers right now. Today 75% of consumers are still choosing between gas and hybrid engines, and we're really pleased to have that alternative for our customers.
So that hybrid powertrain sort of bridging the gap to when Lincoln will be fully electric by 2030.
Praz, what was behind the move, I guess, in terms of why they outsource the production to China and the potential risk of that, if any?
So Lincoln says that they had to kind of retool the existing Nautilus factory in Canada for its future EV. So they went to China, where they're already making the Nautilus for the Chinese market there. So they decided to just kind of build both cars there for both markets in China. But the issue, you're absolutely right. UAW says this is a stab in the back, right? Why are they doing this? They could have probably built this car in the U.S. But if you're Ford, you can build it cheaply. I saw the car in pre-production form, looked actually pretty nice. I'm not sure if customers actually care. I mean, Buick's Envision's made in China. People don't talk about that. I think this might be more the norm going forward for luxury cars, at least.
Still, the story dominating the auto industry is who can and who cannot get that $7,500 tax credit as related to EVs. What's kind of been the aftermath of the decision we heard yesterday? Are there certain winners and losers? Are we learning more on day two?
Just hearing more about the U.S. automakers with clear winners here, because they have not only the production capability here, but also they're building the batteries and they have better access to resources in this country. So GM, big winner, Ford, of course, and Tesla. Those are your three big winners there for this. And I think you're just seeing that doubling down here.
And losers, Kia, Hyundai,
Rivian too, because they outsource their batteries from, I'm not sure where, but the Treasury Department knows. Let's see, also, I would say you had a lot of Audis, a lot of Volvos, a lot of those companies that have their own EVs, they're no longer qualifying for that.
Yeah, certainly a
game
disadvantage
changer
for those. All right, Praz, great stuff. Thank you. Well, coming up, we are counting down to the closing bell on Wall Street. You're looking at slight gains, we'll call it that, across the board. The Nasdaq and Dow essentially at the flat line. The S&P up about 0.1%. We'll be right back. We are minutes away from the closing bell. Let's bring in Ines Frey with a closer look at today's market action. Ines.
Guys, we opened the markets mixed and we are around the flat line right now, slightly higher for the major averages. Taking a look at our Wi-Fi Interactive, we're watching the Dow, which is flat, the Nasdaq flat as well, the S&P 500 up about 0.1%. We've also been watching the 10-year Treasury note at 3.57%. Looking at the sectors, we have been seeing some weakness in healthcare, utilities, communication services, and you've got industrials and materials technology that has been seeing some gains. Over on the Dow, the components mixed here with Johnson & Johnson after its earnings down more than 2.5%. JP Morgan up more than 1%. And then Goldman Sachs, which reported this morning, down more than 1.5%. Over on the Nasdaq 100, NVIDIA, which you guys have been talking about, up more than 2%. Also looking at Apple, slightly higher. Some of the mega caps, though, a little bit under pressure. Do want to point out cryptocurrency because we've been watching Bitcoin up above the 30,000 level at 30,225 per token. And then just looking at where we're at with some of the commodities, WTI up around $80.78 a barrel. Brent crude trading just above $84 a barrel. Here's the closing bell.
All right, there you have it, your closing bell on Wall Street for this Tuesday afternoon. And you can see the market action, just everything hovering around neutrality with the Dow down slightly, just dipping into the red. The S&P eking out a slight gain, but let's call it a break even. All the way across the board, the Nasdaq hanging on to that 12,153 level. Let's take a look at some of the movers. There's a whole lot of action with the indices. The top movers on the day is Josh Schaefer joins us for this conversation. Good to see you, brother. We got a glimpse into Wall Street's views of the banking sector after a pair of industry giants reported quarterly earnings this morning. Bank of America ended the day slightly higher after scoring beats on both the top and the bottom lines, while Goldman Sachs closing lower after beating on earnings but missing on top line revenue. I guess a bit of a surprise. Pretty strong report from Bank of America, but the investors did not agree. And when it comes to Goldman Sachs, shouldn't all that they reported have been already expected by investors?
Right, and I think it largely is, right, Dave? I mean, you look at the stock off about 1.5% from what we've seen with bank stocks in the last month. That's not that big of a move, right? In the grand scheme of things, maybe in certain times you could say that's a big move for Goldman Sachs. It's really not that big of a move in the grand scheme of what we talked about over the last month. I thought Wells Fargo put a nice bow on bank earnings today. They said, quote, Goliath is winning, a clean sweep for banks, essentially because some have said the crisis is over, at least for now. I think David Solomon referenced that today. At least the crisis is over for now. And I think that's what people wanted to know coming into these earnings, right? And so that was sort of the biggest takeaway, I think, from today. And then also interesting on that Goldman call to hear David Solomon starting to talk about that Apple relationship. And he said that this gives us another deposit channel. Goldman opening up that savings account yesterday with Apple. And I think you want to talk a little bit more about Apple.
Yeah.
But I think that's interesting to see Goldman kind of get in that space because obviously we're talking a lot about deposits these days. Where are people going to put their money? Apple now saying, you could put your money with us. And
I get it. It's a 4.15 interest rate. It's going to appeal to people that just want to keep it all in that Apple ecosystem. By the way, we'll get Morgan Stanley earnings tomorrow. Next up, Apple. Shares didn't move dramatically, ending the day fractionally higher. The tech giant hit a new milestone, which was opening its first physical store in India with CEO Tim Cook on location in Mumbai to celebrate the occasion. Apple is also planning to open a second location Thursday in Delhi. The store openings at a time when the company is looking to diversify its manufacturing away from China. So this really serves two purposes. There's a lot of market share possibility there. They're only, 4 or 5%, the second biggest smartphone market in the world. But to that point of also outsourcing, getting away from your dependence upon China.
Right, you're getting away from your dependence upon China, and I think it's interesting to see a lot of Wall Street analysts comparing this moment for India to China about 10 or 15 years ago, right? And so you can sort of extrapolate some numbers out from there. CFRA is saying that Apple's iPhone sales now make up about less than 5% of the smartphone market in India, But if it were to make up what they are in China, then you're going from 7 million smartphones to 252 million smartphones sold, 7 million to 250 million. That's a big difference. And then also when you talk about production, right, you're growing from a 7 to 8% production rate, or that's the percentage of their production that's in India right now. They could see that being 25% at some point. So half of their production going to India. So obviously a big moment maybe coming down the line, right? This feels like a seminal moment for what we might see moving forward.
We also got some news on that VR headset that will be released at the Worldwide Developers Conference in June, sold a few months later. They're going to incorporate that into everything, including wellness, meditation, fitness plus. You're going to be able to read books on the goggles, so $3,000 plus. Meanwhile, NVIDIA shares climbing by more than 2%. Okay, we're going to go ahead and go to Shauna Smith here. If you are ready,
yeah, guys,
on United.
Looking into this, it looks like the reaction here after hours, we're looking at losses of nearly 2%, adjusted loss per share of 63 cents. The estimate out there was a loss per share of 73 cents, so narrower than expected. Q1 passenger revenue of $10.27 billion. That was exactly in line with what the street was expecting. Their operating revenue for the quarter, $11.43 billion. That was in line with expectations as well. But again, the stock off just about 1.6 here in after hours trading. They do see their 2Q adjusted EPS of $3.50 to $4. The estimate was for $3.59 here, and they do still see their full year adjusted EPS of $10 to $12. The estimate there was for $8.54, but again, a narrower than expected loss, adjusted loss for the first quarter of 63 cents. The estimate out there was for a loss of 73 cents. Revenue in line with expectations, $10.27 billion, although not enough for the street here, with the shares off just about 1% in after hours, Dave.
All right, we're going to get back to NVIDIA now. Let's check out how shares finish there. Not an earnings alert. All right, here we go, about 2.5% gain as the final reluctant sell, double upgrade to a buy. And Josh, what got that one remaining holdout to switch over to a buy? Presumably AI.
Of course it's AI, right, Dave? And I think it was interesting to look at how much it was the AI pricing power specifically is what HSBC called out here. And so when you think about pricing power, it's how much more they can make per chip when you're talking about generative AI. And they were saying 10 to 20 times more is what NVIDIA could expect at that point, which I thought to be very interesting. And also NVIDIA's overall market share in generative AI expected over the next year. HSBC basically saying NVIDIA could own this market at about 90% market share. And should add here, they went very bullish on this, more than doubling their price target and becoming very bullish. I think it's about a $355 price target they placed on NVIDIA for this move. And really, it's been interesting to watch the stock move in NVIDIA up almost 90% year to date this year as they've continued to mention AI, really riding that train, Dave, that a lot of these companies have them. And when it comes to not only mentioning AI, but dominating AI, right? You have NVIDIA dominating the chip space, Microsoft dominating the AI space, the ChatGPT space, right? And you've seen that sort of take off versus others that have been slower to come, like some of NVIDIA's chip partners, like an Intel, falling, I think up about 20% this year compared to NVIDIA's 90%. And you've seen Google fall on times when Microsoft has been positive in the AI space.
No one at all worried about PC sales with the impact of AI. Josh Schaefer, great stuff. Thank you, sir. More breaking news right here. Shares of Netflix trading, let's see, minus 8% after hours. Q1 earnings are in. Shauna, what are we seeing?
It's all about the 2Q outlook, at least right now. 2Q revenue outlook coming in a bit light, $8.24 billion. The estimate was for $8.47 billion. Also, the headline number from Q1 is this subscriber number coming in below the street's expectations. 1.75 million was added during the quarter. The estimate was for 2.4 million, so a pretty big miss there on that very important key metric for Netflix. Taking a look at some of the other numbers here from the quarter, and the top and bottom lines are looking at revenue of $8.16 billion. That missed the street's estimates of $8.18 billion. EPS, earnings per share, coming in slightly better than what the street was looking for, $2.88. That they beat there by 2 cents. But again, a miss on their 2Q revenue guidance. Also, the fact that their subscriber numbers coming in a bit light in terms of what the street was looking for. That is the two big reasons why we're seeing the stock off just about about 7% right now. Brad Smith is here. And Brad, I know you've been digging into this report. What do you think of it?
Yeah, I think for the options market, they had actually priced this one almost to perfection. We were looking at, coming into this report, an implied volatility or an options market driven move of about 7.5% or more. That's exactly what we got. And if you were taking a look at that share price reaction, we were down at one point as much as 8.6%, but ultimately right now down by about 7%. And so that's where you're seeing some of that implied volatility driven by the options market. But then additionally here, you talk about some of the expectations that were ultimately missed. And that streaming paid memberships number certainly getting a lot of attention here. I think after hours in this mixed bag of earnings. Of course, they talked about launching paid sharing in 4 countries. They're pleased with the results, they said. They're planning a broader rollout, which we know could include the U.S. and will include the U.S. according to their statements in Q2. They're also saying that given current healthy performance and the trajectory of their per member advertising economics, let's think about that ad-supported tier there, particularly in the U.S., they're kind of upgrading or announcing an upgrade to their ads experience with more streams and improved video quality to attract more consumers there. But saying in summary that they're off to a good start in 2023, I think Love is Blind fans out there would say hold my beer, because they've got some comments on that front on the live streaming side of some of the ambitions that they've moved forward with at Netflix.
Yeah, certainly. I think a lot of people want to hear a little bit more about what happened with Love is Blind over the weekend on this earnings call that we will be covering. Brad Smith, thanks so much for breaking down this report. Be sure to watch Yahoo Finances after the call today. Brad and I are going to be breaking down Netflix's earnings call. We're bringing you the biggest headlines from that. You certainly won't want to miss it. Well, coming up, are you still watching? Netflix earnings are out. The crackdown for password sharing is all the rage, but certainly that miss there on TQ revenue guidance and also the streets and also the numbers here for subscriber growth, missing what the street was looking for. That's the big reason why the stock is off. Stay tuned. We'll be right back.
All right, shares of Netflix have bounced back a bit. We're down more than 8% at one point, but now right around 5% after reporting Q1 earnings. Let's break them down with Santosh Rao, Manhattan Venture Partners Head of Research. Good to see you as always, sir. Your reaction to the report, what stands out to you? Why are shares down 5%?
Yeah, I think the knee reaction is down. It's a slight miss on the revenue. EPS is also a slight miss. But I think there's a lot of puts and takes here. They've pushed out the password sharing crackdown to the second quarter. So I think that's going to play out. So for me, the Netflix story was really about the second half of this year. The first half was there's a lot of in and out here, a lot of adjustment going on, rollout issues, friction, and all that stuff. So I think what you'll see is the initial reaction is bad in the sense that I think what's really bad is the guidance. And guidance is bad because they're saying the subscriber count is going to be essentially the same as the first quarter, which is historically the slowest quarter. It's a slow quarter, essentially, one quarter, seasonally slow quarter. So I think for that, I think people are saying, are things going bad? Are people just dropping out? They're not. They don't like the ad base. So many questions come to mind. So at this, we'll wait and see. We'll hear the call, see what's going on. I think it's really a second half story. Netflix is. With the first half, we'll have to see. Definitely, the first quarter was slightly worse than what we expected, but we think it's okay. It's within reason why things are happening the way they did.
Yes, Santosh, certainly the push into advertising, a huge focal point within this report, is probably going to be brought up a number of times on the call this afternoon. What does this tell us, if anything, just about the current ad landscape and what that could potentially look like over the next 3 quarters?
Yeah, I think, well, they're rolling out. They said they're trying everything. Either they'll have to increase the CPMs or increase the views. There are a lot of adjustments going on. So at this point, I don't think we know exactly how the ad business is doing, the ad initiative is doing. But it's definitely, they expect it to do very well, and we expect that to do well. It's going to be incrementally positive. It'll stop the churn, lower the churn, if anything. So net, I see a lot of positive effects, but I think at this point, we don't know how it's being received, who's taking the ad, are there new subscribers taking the ad part, or is it the premium subscribers coming down? So all those issues have to be sorted out. Overall, in the long term, I think they needed the ad business. That's another revenue engine that they needed, and they have. So there's no question. The password crackdown and advertising is net positive for the company. It will bear fruit in terms of profitability and subscriber growth down the road. But in the initial phases, there's going to be a lot of adjustment and friction. So we'll wait and see what happens. The second quarter number is really the pushing out of the crackdown to the second quarter. I think that's going to lower the subscriber count next quarter. It probably had a slight uptick here, but not as much as we expected in the first quarter. So, like I said, a lot of puts and takes still, and we need to hear the call.
We certainly do. All important. And now we're also going to be the first call since Reed Hastings stepped down and Greg Peters, the former CEO, moved into that spot. How do you expect it all, the leadership, the direction to change?
That's another thing. It can go either way. Hastings was the star of the show, so it's going to be an adjustment. We'll wait and see. The new management has been around. They know the business. They're plugged in, so it should be a seamless transition. But let's wait and see. It's nothing like the founders, nothing like the original guys, the visionary guys. They guide the company. But at this point, I think the company has moved on to the next phase of its development. It's more into profitability, more into efficiency. It's more about quantity. It's more about quality rather than quantity, which they have said already. So all those things requires good management, good execution. And I think these two executives are the perfect people for this. So net, I think it's a good transition. And they will do well. But we'll always miss Hastings.
Well, Santosh, speaking of things that the company is looking to going forward, live programming, and they had that massive glitch over the weekend with the live what was supposed to be the live airing of the Love Is Blind reunion. How big of a black eye do you think this is for Netflix, and what does it tell us just about their ability or lack thereof to be able to handle live programming?
I think they'll get a pass. If you ask me seriously, yes, it was not needed, should not have happened. But these things happen in live television. So I think they'll get a pass and they'll get the benefit of doubt going forward as well. So we'll see. I think one thing that's good for Netflix, and that's going to come in handy if the strike it comes true. The scripted television that Netflix has that's ahead of the competition, that'll help them out. Plus their international programming and the international footprint will help out, ride out any negative consequences of the strike if it does happen. So in that sense, overall, it's well positioned. Yes, this live mess up was not needed, but they'll get a pass, I'm sure.
Also news, Santos, that they have sent out their final red envelope actually in September. They will cease to send out DVDs. A sad day for a lot of people in America.
Yes.
Santos Rao, good to see you, sir. Thank you.
Thank you.
All right, some breaking news here on Yahoo Finance Live. Fox News has settled its defamation suit, reaching a last-minute settlement with Dominion Voting Systems. Vanity Fair special correspondent and hoax author Brian Stelter, my former colleague at CNN, has been covering this saga. Brian, good to see you. What are we learning about the settlement?
We don't know how much Fox is paying, and we don't know if there will be on-air televised apologies. But I do have this statement just in from Fox. I haven't read it yet, so I'll read it to you. It says, "We are pleased to have reached a settlement of our dispute with Dominion. We acknowledge the court's rulings find certain claims about Dominion to be false." So in other words, Fox is admitting some of what we were airing was a lie. Fox goes on to say, "This settlement reflects Fox's continuing commitment to the highest journalistic standards." And then here's the key. "We are hopeful that our decision to resolve the dispute with Dominion amicably, instead of the acrimony of a divisive trial, allows the country to move forward from these issues." So Fox is saying they're doing it for the good of the country, the good of the United States, to settle this trial. The truth, Dave, is Fox wanted to settle this from day one. It was Dominion that was holding out. Dominion was holding firm, believing they had a very strong case. And I think what we've seen happen here is Dominion using all of its leverage to push Fox right up to the brink of opening arguments before agreeing to terms that must have been very favorable to the company. But again, we don't know the specific terms yet.
Yeah, Brian, what about, I'm sure there are a lot of people out there who aren't happy with Dominion for settling, the fact that this didn't go all the way to a jury verdict. How should this be viewed just in terms of how big of a win maybe this was or realistically is here for Dominion?
I think it is important to recognize that the big lie of 2020 is still ongoing today. It is not yet over. We continue to hear Donald Trump and some of his allies promote these lies. So Dominion wanted to have accountability and get the truth out there. By the way, I said the settlement total was not yet known, but right now the lawyers are outside on the courtroom steps and they are claiming it's a $787 million settlement. So basically $750 million. You'll remember Dominion claimed damages of $1.6 billion. So that means Dominion's getting almost half of what it claimed it was owed. That's an incredible sum of money. I'm digesting it as we hear the number. Almost $800 million for these lies that were spread on television. This is going to be a landmark moment for accountability when it comes to the big lie.
Interesting to see the stock reaction, though. It almost is met as a positive by investors because they have that kind of cash on hand, so it may not change anything financially. But Brian, you keep your eye on Fox. Will it change anything in terms of the programming? There was a sentiment that if they settled, Fox would never change its behavior. What's your perception on that?
I think what we've seen on Fox is something a little bit different. They don't name Dominion or the other voting technology company, Smartmatic, that has also been suing Fox. They don't purposely demonize those specific companies. But some of the biggest stars do still sow doubt about the voting elections, the voting systems in our country, do sow doubt about the integrity of our elections. Unfortunately, that is something that even a giant lawsuit cannot change. But look, $800 million, most media companies would not even be able to afford that hit. You're right, Fox has $4 billion in cash on hand. They can afford this. It'll be a painful blow, but not a mortal blow for the Fox Corporation. But still, to have to pay that much money that could have gone to journalists or anything else, that is going to have a significant influence, I think, on Fox News going forward. I would be really surprised if the current leadership at Fox is still there in 3 months. This is the kind of thing that would cause typically leadership changes, maybe talent changes. This will have real consequences for the network.
Yeah, do you think any talent heads will roll? And what about this other lawsuit, Smartmatic, which I'm here has been waiting in the bullpen?
Smartmatic is in some ways the even more challenging case for Fox. If the Dominion case was strong, Smartmatic seems to be even stronger. So now the odds of a settlement in that case are even higher. And now the bar is set, the floor is set for how much Smartmatic will be paid. If Dominion is getting $780 million or so, then you'd expect Smartmatic to hold out for that much or even more. So at the end of the day, we're talking here about billions of dollars that Fox is going to have to pay out as a result of what was reckless behavior, what was irresponsible behavior. It wasn't found to be criminally defamation, but it was clearly unjournalistic and unethical. Yeah. And that's been exposed in a way I've never seen with Fox before. Fox News has been around 20, 25 years. It's one of the biggest brands in media, has so many loyal fans. It's never been exposed the way it has been today.
Brian, on the complete flip side here, I talked to some free speech advocates that were really hoping for a settlement, and that's in particular because the potential for this to open the door for lawsuits right and left at all types of media organizations had it gone the other way. Your thoughts on that?
There's been this very interesting debate about what the rules, where the standards should be. How easy or how hard should it be to sue a media company, to sue a newsroom for defamation? The Supreme Court 60 years ago set that bar very high, which is why you almost never see it happen. You almost never see a case almost get to trial the way this did. However, some Republicans want to loosen those laws, make it easier to sue news outlets. And yet, I think if that were to happen, outlets like Fox, which are much more hyper-partisan, which engage much more in opinion and much less in gathering the news, they would be very vulnerable if that bar were to be lowered and it became easier to sue a network like Fox or an outlet like Yahoo or a newspaper like New York Times for defamation. Those protections have benefited Fox for many, many years. So this is a really interesting, discussion, this tug of war that's going on about how high or how low the bar should be for libel. And this case really pushed it to the brink because there was so much evidence Dominion had accumulated of possible defamation.
All right, so people can follow you at Brian Stelter. How do they get more on the podcast? Are you doing a special edition for Vanity Fair?
We are for Vanity Fair, and now we're going to have to do an emergency podcast. It's up on Inside.
All right, we'll check that out. Brian Stelter, good to see you again, my friend. Thank you.
You too. Thanks.
All right, coming up, we take to the skies and break down United Airlines' first quarter earnings report right after the break. Stick around.
United Airlines reversing earlier losses after reporting fiscal first quarter earnings. Now shares trading to the upside, up just about 1.7%. Adjusted loss per share 63 cents, narrower than what the street was expecting. Operating revenue up 51% year over year to $11.43 billion. We want to bring in Scott Forbes, Jefferies Aerospace and Defense and Airlines Equity Research Senior Associate. Scott, it's good to see you here. So just first, your take here on these numbers from United, a narrower than expected loss of revenue in line with the street's expectations.
Yeah, I don't think there were going to be too many surprises today going into it, given they had just updated their Q1 and Q2 guidance as recently as March. But generally, I think it's really just about executing on Q2 now. They've put out a revenue guide, and I think it shows how strong summer demand is and how much leisure travel is really held up. And now you can just go out, execute on it, and make sure kind of investors are right. But it's generally a good print. I think it's shown that demand has continued into the summer and costs are under control for both Q2 and for the full year, which I think is a little better than investor expectations.
Certainly some questions on costs when it comes to the OPEC production cut. Any impact for United?
Well, I think in Q1, one of the big investor concerns was that their fuel guide was really, really aggressive, I'd say. And they've come out with a Q2 guide of $2.80 to $3, which compares to spot jet right now at around $2.50. So it's fairly conservative. It gives them some room to work with. There's obviously an impact from the OPEC production cut and the general rise in oil prices. But generally, I think this is better than what investors expected.
Scott, what are you seeing from your demand checks? Are we starting to see that picture crack at all?
I think slightly from where we were last summer. I mean, demand has been so strong. Leisure customers have been around 120% of 2019 levels. We've probably reached the peak, but relative to 2019, we're still 20 to 25% above where we were. So there's still a lot of room for strength. Airlines still have a lot of room to run, and demand does not seem to be fully cracking back to where we were in 2019. It's still remaining fairly strong, even with some slight year-over-year declines.
Scott, what about the fact that United is among the airlines that are going to be trimming flights at a couple of airports because the FAA requested it due to staffing shortages? Is that going to have a material impact, do you think, at all over the next 2 quarters?
Yeah, it'll likely have some impact on the capacity side, but the offset to that is really whenever you have supply constraints across the industry, which is what we've seen through 2022 and 2023, where it's been pilots, it's been delayed deliveries, and now you're seeing air traffic control shortages, is a lot of it just immediately gets offset by price. I mean, demand is still really strong, and any kind of supply shortages, any kind of supply constraints will likely be offset by higher prices, and the airlines are really, really able to kind of push that a little more in those areas where air traffic control shortages are being felt.
Every airline is dealing with the pilot shortages and re-upping their collective bargaining agreements. Where is United and what's the impact?
Yeah, so United has baked in probably a 3-point unit cost impact for their new labor contracts for 2023. They haven't quite come to an agreement yet, but given Delta's already signed their collective bargaining agreement with their pilots, it's likely that both American and United kind of just move in line with Delta, which is what we've seen historically with these negotiations.
And Scott, what about the international component of this? Because within this release, United did say that they are seeing growth in overseas flying that's really outpacing, it looks like, domestic flying. How big of an advantage, or I guess, does this position them in a better place than maybe some of their competitors out there?
Yeah, I think United is a little unique relative to the industry, which is when you saw Delta retire some of their larger 777s. You saw American retire some of their older wide-body aircraft. United didn't retire any of them. So United's poised to come back into this market as international markets recover with a much larger wide-body fleet than pre-pandemic. So you've seen them fly over the Atlantic at 20 to 25% more capacity than they did pre-pandemic. Open markets like Mallorca and Bergen that they've never had previously to give them a try. And now you're seeing the Pacific start to open up, and Osaka, Shanghai, a lot of those services restart. So it's definitely an area where United has a competitive advantage. And I'd say an area where, given supply constraints across the industry that we've seen in the U.S., a lot of it's even worse in terms of retirements that we've seen in European airlines on the wide body side, with Lufthansa getting rid of like A380s and 747s, for example. So there's a lot of room to run there and a lot of yield upside to come internationally.
And Scott, finally, the latest disaster for Southwest Airlines, a ground stoppage earlier today, another glitch. The stock plummeted, since recovered to about level. How concerned should investors, let alone passengers, of Southwest be?
Yeah, well, the actual ground stoppage in the end only lasted around 12 to 15 minutes. So it's something that I don't think would have been too much news if it wasn't Southwest. I think we know Southwest needs to invest more in their technology. They're doing $1.3 billion of investment annually, which is up from their prior $1 billion a year. So it's something that we continue to watch. It's something that I think they're fully aware that they need to invest in. And it's just, it's incidents like this that kind of reinforce that.
Scott Forbes, thank you, sir. Appreciate that analysis. All right, coming up, Congress fighting over the debt ceiling as fears of a June deadline mount. We speak with a strategist about that next.
Is the banking crisis over?
I hope so. It does feel like it's largely contained, and although they have their detractors, I think you have to give credit to the Fed and other authorities for the speed at which they moved. I think maybe the debate now has probably moved on to the extent that we're seeing the big bank, kind of small regional bank divide open up. And that's what this week's earnings will be so critical on.
We're not saying there's a banking crisis, but we have lived through a scare. So I think deposits are leaving the system. They're being attracted into money market funds by the 5% rates that are on offer versus the sub 1% you get at your bank. That predates SVB and the recent banking scare. So I think that's going to continue.
We think we are moving from the crisis phase to the stabilization phase. And I think as we move into earnings season, what we're going to see is trends that we expected to envelop as the banking crisis did play out, which is deposits, meaning flows, deposit costs, and the mix of deposits changing from those that are non-interest bearing to interest bearing.
Do you think the crisis is over, or this might flare up again over the summer?
I think it's too early to say with any definitive knowledge. The place to watch is the mid-sized regionals, the PNCs, the M&Ts.
Congress is back in session after their spring vacation, and they're already fighting over the debt ceiling as fears of a June deadline mount. Joining us now is Brian Gardner, Stifel Chief Washington Policy Strategist. Good to see you, sir. So Kevin McCarthy was at the New York Stock Exchange yesterday. Some very critical remarks of President Biden, but also saying their plan is to pass legislation in the House that would cut spending, quote, make us less dependent on China, curb inflation without touching Social Security and Medicare. The president reacted today. I want you to listen.
Yesterday, the Speaker of the House of Representatives, Kevin McCarthy, went to Wall Street. He did not tell the wealthy or the powerful on Wall Street that it was finally time for them to start paying their fair share of taxes. That didn't come up. Other than say they're going to renew the $2 trillion tax cut. Anyway, I won't. Instead, he proposed huge cuts to important programs that millions of Americans count on.
Brian, before we get to where we're headed, your reaction to the back and forth from McCarthy and now President Biden.
I think it's kind of what you would expect. Two sides that see the world very differently and are sparring in the public space. They're never going to come to a philosophical agreement on taxing and spending. So with the debt ceiling looming, it puts their differences front and center.
Brian, when you take into account what we heard from McCarthy saying that his plan is going to include spending cuts, no details on where that would exactly come from. Do you have any idea maybe what the GOP is potentially thinking about at this point?
Yeah, I mean, there are a couple of items such as clawing back unspent COVID funds, canceling the student debt cancellation proposal by the Biden administration. Those are the major cuts. I think a lot of the other items that the GOP is looking at are probably caps on spending, so reducing the rate of growth of spending. There would be a lot of disagreement within Republican circles on actual cuts because not everybody sees the same way as the speaker does or as the conservative wing of the Republican Party does. So I think we're looking at a couple of areas of real cuts, what the average person thinks of as cuts. And then a lot of it is going to rely on reducing the rate of growth in spending programs.
So McCarthy's talking about 22 levels of spending. Those on the far right that you referenced, the House Freedom Caucus, want 2019 spending levels. What's the likelihood you think he gets a deal out of the House?
So I think that illustrates where Republicans are and that there's a lack of agreement among Republicans about what they should be doing. Even freezing in at 22 is difficult given the rate of inflation. So I think they're going to struggle to get something out of the House. I do think McCarthy can rely on Republicans' sense that they need to have something out there, that they have to be team players, that they're going to put some of their personal preferences and even take a tough vote politically for them, depending on their district, to get an opening bid out there. But I think it's going to take them a couple of days to kind of work through this. That 2019 number, I don't see any way of that passing. I'd be very, very surprised at that passing. The 2022 number is probably not enough for some conservatives, but I think McCarthy can lean on them to keep the process moving and get this bid out, an opening bid out from the House so they can kind of jumpstart the process.
Yeah, Brian, what do you think the realistic timeline looks like on this? Because from what you're saying, it still sounds like there needs to be significant progress before we get any sort of deal.
Yeah, so it all depends on the cash flow of Treasury, and we really don't know that definitively yet. There have been some estimates from CBO, Congressional Budget Office, and others that it could be summer, late summer. There was some suggestion earlier today that tax receipts are lagging, and so this X date when Treasury exhausts their extraordinary measures, that could come as early as mid to early June. I think in the next couple of days or weeks, as we get more clarity on the cash flow issue and tax receipts, that X date will become more front and center. And when it does, I think markets will start to really pay attention to that, because to date, it's been the situation in the banking industry, the Fed, now earnings season, and markets and investors have been discounting these headlines. That's going to change. And when it changes, it's going to change suddenly.
Bottom line, when all the political theater is over, would you say we'll get a clean raise?
I typically say a clean raise. No, I don't think there will be a clean raise for two reasons. One, I think Democrats are going to have to go along with some kind of cuts. Even moderate Republicans want, when I say cut, like I said before, reduction in the rate of growth. Even moderate Republicans want some concessions. And I think there are a number of Democrats who will go along with concessions. So I don't think it's going to be a straightforward hike in the debt ceiling. But the process is going to continue to be messy. Typically, when you get close to that date, I'm usually confident that they'll get a deal at the last moment. Got to say, this time around, I'm less confident in that prediction than normal. These are different times, especially given a very narrow majority that McCarthy has in the House. This is going to be a much more difficult lift than we saw in 2011.
Speaking of how different these times are, you've got a potential frontrunner for the 24 nomination. That's Ron DeSantis, the Florida governor, the top competitor for Donald Trump. Instead of talking about potential spending cuts in Washington, he is continuing to focus on Mickey Mouse, on Disney, on, quote, building a prison next to Disney in Florida, and even taking on Bud Light for their controversy, their campaign with social media trans TikToker Dylan Mulvaney. Is this an effective political strategy for a Republican candidate?
Very much so, especially in the primary. I think the Republican base has been changing over the years. There's a realignment going on in both parties. The Republican base has become more populist. And so the lines coming out of DeSantis, which are similar to what you would have heard from Donald Trump over the past few years, they're not traditional Republican stances, but in a Republican primary where the base is heavily populist, and you're taking on what these voters will see as large concentrations of power, I think it's very effective. Then the question is, does it hurt him in the general election? I sense not that much. I think in the general election, votes will be shifted on policy issues in the economy, not parochial issues down in Florida. So I think it helps him in the primary. I'm not convinced that it really hurts him all that much in the general election.
Fascinating. All right, interesting times indeed. Brian Gardner, good to see you, sir. Thank you.
Thank you.
Business majors set to graduate this spring may have to wait to start after their college careers. According to the Wall Street Journal, consulting giants McKinsey & Company, as well as Bain, are planning to delay start dates for their new MBA hires. And even in some cases, like Bain, offering to pay incoming employees tens of thousands of dollars to put off starting their jobs and take on learning a new language or even becoming a yoga instructor. This interesting report from the Journal details $40,000 payments that would take on a nonprofit work, $30,000 for an educational opportunity, and yes, even paying someone to become a yoga instructor. Now, Sean, at the backdrop of this is worrying about a potential recession later this year, presumably, and wanting to push those hires off.
Yeah, it's going to be interested to see how many of these potential hires or hires here actually accept some of these offers, because you got to think there's still a lot of demand, a lot of competition for these very, very qualified recent graduates. But clearly just illustrates to us what time we're in right now, how many companies are readjusting their plans to brace what could be a very potentially a very slow second half of the year. It is much better than maybe what we've heard from some of the larger accounting firms. EY, which is accounting and also consulting firm, they announced that they're eliminating positions, so job cuts there. KPMG back in February also announced that they are laying off several hundred people from their consulting division. So clearly, these consulting giants are readjusting their business, given the fact that we'll likely see some sort of economic slowdown in the second half of the year.
Yeah.
If you're one of these people, though, and you can afford it, if you have enough savings and you can afford it, not a bad gig. But a lot of people need a steady paycheck.
Yeah, if mom and dad paid for business school, cool, I'll go take a year and be a yoga instructor. Yeah. But if you have student loan debts, This is a massive problem, double-digit. You're taking on $100,000 a year. All right, straight ahead, a closer look at Johnson & Johnson earnings and the latest on their spin-off plans ahead. All right, another earnings mover today. Johnson & Johnson, you can see the stock down almost 3%, despite reporting better than expected results and raising guidance. Yahoo Finance health reporter Anjali Kamlani here with the details. Anj, the company also giving an update on its spin-off plans. What did we learn?
That's right, Dave. So the spinoff for Kenvue still underway. The company has filed for IPO, but it is not publicly traded yet. The last we heard about this was from CFO Joe Woke at a conference last month saying, quote, as of really the beginning of January, that business has been running on its own. It's just not publicly traded on its own yet. And of course, as you just saw on your screen, it's not the only company to be spinning off its consumer unit in the pharma space. We've seen that trend building up as the alignment of business splits as consumer brands are focused more on, as the name suggests, the consumer, and the clinical side is really still tied to the larger healthcare industry. It's important to note also that Kenvue itself, or rather what will be Kenvue, that consumer unit, is a really profitable part of the business for Johnson & Johnson, but it does not necessarily carry that sort of big name, big brand, and big revenue that they tend to look forward to as they're going to get leaner and into this two segment. Johnson & Johnson today has about 30 products that are billion-dollar brands. Meanwhile, after it spins out Kenvue, that'll just reduce to 26, so not too much of a big hit there. But as it stands right now, still waiting for things to take place and for the official launch. And meanwhile, not necessarily going to be a big hit for the company, but consumer unit really strong there and brought in about $15 billion last year for the company. So it'll be interesting to see what Johnson & Johnson looks like after that.
Indeed it will. Thank you for that reporting, Anjali Kamlani. Appreciate that. All right, Shauna, what is moving after hours?
Got a couple of names for you here. We have Netflix, United, Western Alliance, and Intuitive Surgical. So let's get into it here. Netflix, it was initially selling off following its latest earnings report, but you can now see it up just about 1% after hours. So a lot to unpack here in terms of the top and bottom lines. It was a mixed result here from the company. Revenue coming in just a bit light, $8.16 billion. EPS better than expected, $2.88. The company, though, did miss on its Q1 subscriber number. That came in below the street's expectations, 1.75 million. The street was looking for 2.41 million. Also, their 2Q revenue outlook missed expectations, yet we are looking at gains of just about 1.5%. So maybe the street is not as worried about this update here as they initially were. Year to date, we're looking at gains of just about 13%. Over the last year, you're looking at Netflix shares still in the red, off just about 1%. All right, let's flip it over to United Airlines. Not a heck of a lot of movement here after hours. You can see the stock is actually flat here following the most recent results. Narrower than expected loss of 63 cents. Operating revenue up 51% year over year, coming in exactly in line with what the street was looking for, $11.43 billion. The company also saying that the rebound in international travel, coupled with the fact that they are expected to lower their operating costs here, that is going to lead to a better than expected 2Q profit. You're now looking at gains of just about 1.5% year to date. The stock up about 14%. Flipping over to Western Alliance, one of the regional banks that has been under a tremendous amount of pressure recently, but you're looking at gains of just about 17%. Now let's put that in perspective with everyone, because when you take a look at that 2-month chart, you're still looking at losses of about 56%. When it comes to this earnings report, EPS lower than what the street was looking for, but adjusted revenue did beat the street's expectations. Also, Q1 total deposits coming in just below what we were looking for, $47.6 billion. The company did say, though, that deposits in the second quarter, during the first 2 weeks of the second quarter, actually increased by $2 billion. So certainly a vote of confidence there from some investors. And you're looking at gains of just about 16%. Wrapping up with Intuitive Surgical, the robotic company here, up about 8% after hours. They beat here on both the top and bottom lines. Revenue, $1.7 billion. That's up 14% year over year. Adjusted EPS, $1.23. Over the last 2 months, you're looking at gains of just about 12%. Over the last 6 months, the stock up nearly 40%, Dave.
All right, Shauna, good job. Thank you. Stick around. We'll get you caught up on the biggest business stories from the day. Next.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc., that's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
All right, recapping where things ended the day. It wasn't too much movement on the street. We didn't end too far from the flat line. All three of the major averages here. The Dow closing just below the flat line. S&P holding on to gains up just about 0.1%. Well, that'll do it for us today on Yahoo Finance. Be sure to watch after the call at approximately 7 p.m. Eastern Time. Brad and I will be breaking down Netflix's big earnings call that will get underway in just a minute. And of course, Dave and I will be back for you tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. Have a good night.